Hi everyone, so welcome once again. In our enterprise risk module, we'll be taking a step further. We are looking at operational risk management. What I'll say as an introductory um, statement to this topic is that operational risk management cuts across every aspect of, if you know, of any organizational activity. You go to the bank and you hear operational chief operations officer. What does it do? Okay, it tells you that within the banking system there are operational activities that goes on. So there are risks associated with any of these activities. So operational risk management does not just apply to only profit making, it applies to non-profit making as well. It applies to listed, unquoted companies, private, public sector, once they undertake operational activities to sustain their to sustain their status as going concerns, then we should know that operational risk could be associated with their work. So we'll be looking at operational risk management. Um, Once again, it's exhaustive. It is not exhaustive. Let me put it that way. We it is an introduction. Okay, it's an introduction. So we'll be touching on one or two key core points, and then we'll try as much as we can to learn something that we can apply both in industry, in practice, and in every aspect of our lives. Okay, so as we always do, we'll split it into two sessions so that it wouldn't be too boring listening to a 1 hour video, 45 minutes. I'll try as much as possible to keep it brief, but still touch on the key points. As usual, keep in touch with the model leaders. Our learning objectives is to look at the main drivers. We should understand what operational risk mean, the scope of it. Okay, what are the drivers? What drives it? And also, we would like to look at the types of operational risks that exist in an organization. Examine the evolving nature of operational risk and apply it. We should apply the normal risk management framework. The identification, assessment, mitigation, control. Okay. And then we'll also look at two key aspects of any operational activities of a firm. Operations in any organization, we deal with cash. Cash is key. Cash is the lifeblood of the organization. And we'll look at the trading manufacturing companies where they will deal with inventory controls. Okay, so we'll look at our economic order quantity and how it applies to both inventory and cash management practices of an organization. Then we'll look at the two main cash management models, the Baumol and Miller-Orr models, and then try to see. We normally know of three driving motives for holding cash, but it is understood that there's a fourth one. We'll just look at it briefly. And then we'll look at operational risk management functions and the risk culture of an organization. So, following the financial crisis, almost all firms, profit making organizations, have decided to restructure their operational activities so that they can survive any future mishap that may come up. All right. And in the same way, even in current days, the not for profits have also implemented strategies to ensure that the donations they receive from their donors are implemented and dispersed in the right manner, in line with the conditions of the donations or the operational mandates. So operational risk management looks at both sides, whether you are making profits or you're not making profits. Now you remember in our introductory um, lessons where we look at the evolution of enterprise risk management, we mentioned Basel II. Okay. Now, according to Basel II, it defines operational risk as the risk of loss which results from inadequate or failed processes, people and systems, or from external events. Look at the drivers over there: processes, human factors, systems, and uncontrollable external events. So it plays a key role in determining the overall risk of the firm, and it is also considered for calculating regulatory capital, which is normally required by the supervisors, the regulators to support resilient financial systems, following again from the financial crisis. So normally losses which are incurred from operational risk can be significant. Some can be quantified monetarily, some cannot be quantified, but it can lead to reputational damage. Okay, many firms have suffered reputational damage as a result of failed operational systems. So we should look at all of this. Okay, it may not just be in cash. Let's take an example, a typical example of failed operations and the consequences on the organization. From 2011 to 2016, major banks have suffered a total of 210 billion in losses from operational risk, okay, stemming from preventable mistakes which they could have prevented, or when employees or systems interacted with clients, they could have blocked it. Okay, you can see fraud schemes perpetrated, systems being hacked, okay, processes are not working. And these are, of course, banks within that space of time, 210 billion dollars. Okay. Now, regardless of the size of these potential losses due to operational risk, the scope and subject matter is complex, complicated. Okay. Sometimes very difficult for us to identify, to monitor, to control, and even to put in place measures that will prevent it from happening in the future. The important thing for us to remember is that operational risks management, which can be determined from its definition from the earlier Basel II Accord, is a highly interconnected discipline. And it looks at many overlapping factors, which range, for example, from the firm staff, the employees in the company, to processes, to IT systems, to natural disasters, COVID, catastrophic events. Okay, if we can manage these operational risks and control them, then of course we should know that we can reduce our losses, both reputationally, both quantitatively, and any long-term damages that could occur to us, our image, and then our brand. I sourced this, took this example from Bain and Company's July edition, the bulletin, which the article which they published in 2018. Now, so like I said, the drivers of operational risk, from the definition, you could see human factors. So when intentionally human beings make a mistake or unintentionally they make an error, it can cause operational risk. Okay. When processes are not working well, flaws in the processes could also cause reputational damage. And then systems failure could also lead to operational risk. And then external events, sometimes we have no control. COVID has caused a lot of operational risk in companies. Okay, you cannot quantify the life of one human being. So if you have a key person working in your company, and as a result of COVID, this person has been affected, or maybe the person has lost his life, you should know that there's a big gap which has been created, and it could affect the future or long-term status of the company. So operational risk management is considered to be an integrated function. Everyone on board should come together so that we can manage this risk process. Okay, so it's an integrated function. It doesn't normally belong to one person. Fraud risk is part of operational risk. Financial risk is part of operational risk. Okay, cyber risk, every aspect of the company, human conduct risk, they are all part of operational risk, and they cut across all dimensions of the company. So, like I said, in terms of scope, it is comprehensive. It includes both financial and non-financial. Okay. So in order to make our operational risk minimal, it requires continuous processes of preemptively identifying these risks, measuring or quantifying them where necessary, assessing its impact on the company, and then monitoring how it evolves, and then we try to control and mitigate these losses, put in measures. Okay. So, like I said, it covers both financial and non-financial. We've looked at a little bit of financial risk management in the previous slide, so we'll not go there. Now, the non-financial risk elements include conduct risk, I said, fraud. We look comprehensively at fraud risk, cybersecurity, vendor risk, data privacy, unauthorized trading, on the stock market, and then information security. Okay. So operational risk usually occurs or it becomes apparent in the presence of these other risks, and the losses suffered could be very significant in the wake of these risks. Okay, especially in the situations of those who make profits, and then in the financial institutions. You know what is interesting about operational risk management is that since it is an integrated function, one risk triggers the rest. Okay, so if you want to seal them, you seal all of them. You don't seal one or two and leave the rest. because the other one, which will trigger, or which you may think is minimal, can trigger the ones we think you've controlled. Okay, so it's better to put in place measures that will comprehensively close off all gaps. Let's look at an illustration how other risk impact operational risk. Like I'm saying, don't close off one or two and leave the rest. Close all of them off. Okay. Now, Bank A offers its retail clients the ability to trade fixed income products like bonds, like gilts. Okay. A customer calls our Bank A broker to instruct the bank to purchase the bonds of Corporation B for the customer's trading account. Now, this broker executes the order, but mistakenly, human effort, human mistake, mistakenly books it as a sell order instead of an intended buy order. I said buy, then you sell. Now, it has the effect of a significant larger loss if the market goes up. You lose. So the cost to Bank A to make this customer whole will be much higher in the face of high volatility than if the market is very stable. In this case, we can see market risk or stock market risk, capital market risk, magnifying operational risk. Okay, it can even lead to damage to the reputation, reputational risk, magnifying it. So other risk impact various dimensions of all the organizations. Let's look at quickly some types of operational risk according to the Basel II Accord, which identified one, internal fraud. So frauds which are committed within the organization against its long-term interests, bribery, theft, misappropriation of assets, tax evasion. Okay, and then we also have external fraud. People outside the company try to defraud us. So they hack into our system, check fraud. They also steal sometimes, okay, hacking unauthorized access to information. We also have employment and workplace safety. Make sure the workplace is safe enough, okay, to comply with all the health and safety laws and regulations. Otherwise, any failure or mismanagement can lead to grave impact on the employee's morale. It can also lead to reputational and financial damage. Staff can take you up and you have to pay some workman's compensation to them, which you have not planned. Some contingent liabilities could arise. We also have clients, products, and business practices. Okay, so where business practices or products fail to live up to expectation. So you're telling us that this will give me a very nice skin, a clean skin, okay, moisture-free skin, and I apply it and it's not working as I expected, then you are failed. Okay, so also includes misuse of confidential information or failure to disclose suitable requirement. We've looked at some examples where the company, or we have even heard recently where the supermarket will withdraw some batch of products because it has not been labeled well. Sometimes they'll say this is gluten free. Meanwhile, it is not. People take and they react. Okay. So these are the let's continue. There are other ones to damage to physical assets. So these are losses which can arise from natural disasters which we may not be able to control. Terrorism, vandalism, tsunamis, earthquakes. Okay. And they can lead to physical damage of property, assets, or operations. Business disruption and system failures, so losses due to supply chain disruptions and the risk of business continuity failure. Okay, so it can also include system failures if our hardware, our softwares are not working as required, our IT systems are not stable, knocking us off in the middle of serious meetings, power outages. Okay, we also have execution, delivery, and process management risks. So events in this category deal with failure of delivery. I will deliver it on 10th and I deliver it on 15th. You disrupt my operations. Customers are on me. They need this. And you disappoint me in terms of timing. Process or transaction mismanagement due to data errors, data entry errors, miscommunication, accounting errors, inaccurate reporting, incorrect client records, or negligent loss of clients' assets. So these are elements which could also lead to overall operational risk or sources of operational risk in an organization. Like I said, operational risk keeps evolving. Given the fact that in our world today, things are changing. Okay, soon, look at the IT systems. the laptop systems, the laptop industry. They are bringing upgrades. Everything is changing. So we also have to adapt to it. Otherwise, we'll stay back and we'll incur more operational risk than before. So operational risk is complex. Once the system changes, it changes. It is interdisciplinary. It cuts across marketing, accounting, communication, operations, everything. It cuts across. It is interconnected and it always keeps changing in line with the current developments of the organization, of the world. Okay. So some of these operational risks we've categorized earlier might stem from somewhat abstract, but nonetheless, operational risk can capture headlines, bring significant monetary damages and penalties, and ruin our reputations. You don't want to see your company's name or your firm's name on the papers. You hear big audit firms, KPMG, EWs, EY, PwC fined certain amounts of money. Deloitte fined because they did not undertake due diligence in terms of auditing some big clients, and they've led to some misappropriation of assets or due to their negligence, okay, on the part of the clients. But you see your company standing on the other end, suffering the damage as well. So don't be alarmed. For example, you have a son at home. He goes out to play. You don't control this son. The son can bring challenges to you. Okay. So as firms, when we are connected with anyone, we cannot say the business school is not connected with the nursing or medical sciences school. If anything happens to the business school of UWS, what happens is the name of UWS which comes into disrepute. Okay. So some of these operational risks cut across everywhere, interconnected, interdisciplinary. They are complex. Okay. Its nature cuts across IT, data breaches, money laundering, schemes perpetrated by both staff within the company and outsiders, customers, could also give us reputational damage when they write bad comments about us. Okay, rogue traders, financial institutions, inventory mismanagement practices, piling up stock of materials, excess hoarding of cash in the office, which could otherwise have been invested or saved in the bank, poor planning in service industry, hiking, over hiring and the hiring of staff, hiring of unqualified staff, poor background checks on newly recruited staff. This cuts across. All of these lead to operational risk. Let's take a notable example of an operational risk in terms of credit card fraud, which occurred in the financial services industry. Wells Fargo in the US. Okay, in 2016 September, the US financial services company, Wells Fargo, reached an agreement with their regulatory body, the CFPB, and which is the Office of the Comptroller of the Currency and the Los Angeles Attorney's Office, over allegations that it, amongst other improper activities, they ended up opening deposit accounts and transferred funds into these deposit accounts without customers' consent. Now, as a result, they had to pay $185 million in fines, plus an additional $5 million in customer remediation. So the totality of this investigation led to unethical conduct. It disclosed unethical conduct, which went as far back as least 2018, where thousands of Wells Fargo employees went to extreme lengths to meet sales targets by opening unauthorized accounts, moving client funds without their consent, and even submitting credit card applications in customers' names without their knowledge. They wanted to meet their target to get their bonuses. Now, they went even as further to fraudulently create email addresses that customers were not aware of in the names of the customers. Now, the regulatory body found that Wells Fargo employees opened a total of 1.5 million unauthorized deposit accounts, 85,000 of which accrued to a total of 2 million in fees. Can you imagine that? On top of this, the regulatory body noted that it discovered 565,000 unauthorized credit card accounts applications submitted on behalf of clients who were not aware, and of which 14,000 of them accrued $403,145 in fees. Okay, that's what happens when the whole company collude or some few people collude to perpetrate some act which may bring the name of the company into disrepute. Now, the operational risk framework, it still applies to all. Okay, the risk management framework still applies to all, and can still be applied into the context of operational risk management. So, to support a very strong operational risk management, we as a company should always try to identify these risks, measure and assess the risk, monitor and control them, and put in place mitigation measures to safeguard the company. Okay, so we must clearly define these risk management processes. Okay, define effective processes where we can collect, assess, and report on this data. Use your risk registers, okay, to record all of this, okay, and have effective risk control procedures in place so that we can minimize the extent of damage to the company's finances, reputations, and operations. Now, I'm not going deep into this risk management process or framework because we've looked at it extensively during the financial risk management session. Okay. Now, we'll take one more step, break off, and then use the next part of the video to attend to the other part of this topic. So we'll now look at inventory management. We all know inventory management from the old story of economic order quantity. So we're looking at every company holds some kind of inventory, whether manufacturing or trading. They will normally hold the raw materials, the partly completed goods, and then the finished goods. Okay. But again, service industries also hold some stock of inventory, sometimes usually in forms of supplies. But the banks, for example, their main inventory are the cash reserves. Okay. For operational efficiency, it is important that we optimize the purchase, the storage, the use of these inventories to avoid shortages so that when customers need this, we don't get it for them. Can you imagine going to the bank and then you need some cash and they tell you there's no cash? We don't want that to happen. Or where we get excess surplus materials when we don't need them, piling up, taking up space and costing us money when we could have bought in some reasonable order. So the use of the economic order quantity or optimal order quantity is a key model in managing inventories in all organizations. Okay, now in inventories, not just the materials, the raw materials, it also applies to cash. Okay, it also applies to cash. Okay, now let's look at it. Why do people hold inventories? Normally, three. Okay, it also matches the same motive for holding cash. Okay, transaction motive so that we can meet our day-to-day operational needs and sales. Okay, so when it occurs when it is not possible to meet the above sales and production requirements instantaneously. So transaction motive for our day-to-day. Then we have precautionary. Hold these inventories to meet extra demand in times of peak seasons. Okay. Also, due to uncertainties relating to demand for future production and sales, and also because of risk and uncertainties in the supply of raw materials for the production and mechanized business, you need to hold these for precautionary reasons. Speculative, you are hearing of possible increases in prices in the future. What do? You buy more and keep them. Okay, so you don't have to wait till that time hits us. Assuming you realize when we heard that there's gonna be fuel shortage or there's fuel shortage, people line up, go and buy fuel in gallons and keep it in their homes. Speculative. All right. Now, relevant cost in conditions of risk and uncertainties, and then the economic order quantity. Usually, there are only two. Okay, these relevant costs are holding costs and ordering costs. So the holding cost deals with the cost of holding inventory. Ordering cost deals with the cost of ordering in the inventories. Okay, so the holding cost includes like opportunity cost on or for investment in stocks or materials, incremental insurance costs, warehousing, storage costs, material handling, and costs of obsolescence. And then the ordering deals with clerical costs, receiving and paying for an order. Okay, receiving and paying for an order. And then the optimal order must be determined by these costs so that we can make good use of our systems. There's always a trade-off between the cost of carrying large inventories and then making loss of money, loss of orders. There's always a trade-off, and the economic order quantity is always considered the ideal. Let's take an example where ABC purchases raw materials from an outside supplier for £9 per unit. The total annual demand is 40,000. And then the holding cost per unit is 1, ordering cost is 2. Now, EOQ formula is always given. You will always be given this in an exam situation where it is 2 times the total demand for the period times cost per order divided by the holding cost per unit, square everything. Okay. So if we have these, okay, you realize that the 2 conforms to this, right? And then the D normally is the total order, and the C subscript O is the ordering cost. And then the holding cost is given as C subscript H. So from this scenario, annual demand is 40,000, which we find here. Okay, the 2 is a constant figure. Whoever developed the formula found this to be a reasonable order. And then we have the ordering cost again, these 2, which appears here. And then our holding cost per unit is 1. When we compute this, we get 400 units. This is the optimal order we need to keep in stock. All right. So in a graphical illustration, the same scenario, what we are saying is that there is the ordering cost, the green line, which slopes down. Okay. Okay. It tells you that there is a relationship between the annual cost against the ordering cost. If I should draw a simple line linking this 500 to the green line and draw it down, and I draw another line from the 300 to the green line and draw it down, what do you see? You realize that assuming this was 180, and assuming this was 390, you realize that when the ordering cost, the annual cost, okay, moves from 300 to 500, what do you see? You see that the stock levels also move from 180 to 390, a downward sloping curve, an inverse relationship. Similarly, we can see the ordering cost, okay, the holding cost moving. I mean, if you don't hold any inventory, you expect to get a 0. So that's more of a positive sloping. The more you order, the more inventory you hold, the more holding costs you incur. It makes sense. So the intersection where we have them, we are saying that the total cost is a sum, or yes, is a sum of the holding cost and then the ordering cost. And where they intersect, the minimal point of the total holding cost is the point where we say it is optimal for us to order. So at this point, where the annual cost is 400, we should order, and we order 400 quantity. That is the optimal level where we need to. In this case, we are not ordering so much, and we are not ordering less. And we are optimizing, we are minimizing the total cost which may be incurred. Okay, that's what we are putting across here. So I adapted this from Drury's Management and Cost Accounting 11th edition, which was printed in 2021. Cengage. So I highly recommend that you get that book. It's very good. You get student resources, everything on it in terms of questions and technicalities. Okay, now we move on to the relevant cost again. So I said the relevant cost is just 2, okay, the holding and then the ordering. And of course, the total relevant cost will be the sum of the 2. So the total ordering cost is obtained by multiplying the number of orders for a period by the ordering cost per order. Usually it's simply the quantity annual demand multiplied by the ordering cost divided by quantity ordered. Okay. And then the holding cost, okay, is given as the average, okay, the Q, quantity ordered average times the holding cost per unit. Therefore, the total cost is given as the 2. This function against that, you add the 2 to get it up, okay. Normally, you get these formulas in an exam, so I don't want to spend so much justifying the formulas. Okay, so in the same scenario, let's take an example. The question is, when you have had this optimal order, is it okay for you to order in batches to make good use of maybe quantity discounts that may apply? Okay, so we can use the EOQ to determine optimal batch sizes which we need to order. Okay, the optimal solution helps us to balance the setup cost against the inventory holding cost. Okay, the setup ordering cost. Okay, let's take an example. 9,000 units to be ordered or annually. Setup cost 90. Okay, ordering cost. And then holding cost of 2. We can calculate our economic order quantity and we get 900. units. Now, firms are able to obtain quantity discounts when we buy in large quantities, but the economic order quantity can be used as a starting point for us to optimize these points, okay, these batch purchases. Here, the intention is that it could help us to save something in the purchase price and help us to reduce the total ordering cost. Okay, so by buying more, we incur more holding costs, but let's see the cost against the benefit. If we incur more holding cost and we still make some discount, let's knock it off and see whether it makes sense for us to pick the optimal batch size. Okay, let's see. So an example, still, say, let's take an example. The supplier in this scenario is giving us, we buy, the cost per unit is 7. Okay, after this, we'll end and we'll continue on the other side. 7. The annual demand is 9, right? So if you should order over the whole year, you get what, 63,000, right? Is it dollars or pounds? It's pounds. Okay, we keep this one. The holding cost, as usual, we can easily find it. An ordering cost has been given. Quantity discount is 3% of the purchase price. What's the purchase price here? Purchase price is this, right? Purchase price is this. All right. When we order in excess of 999 units, should the company buy batches of 1,000 and take advantage of the quantity discount? First starting point is to find the EOQ. So our 9,000 annual times the 5 ordering divided by the 4 holding, get 150 units, right? That's the first starting point. The next is that we should identify if we make any savings when we buy in 1,000 batches of 1,000 units. Okay. First point is that, number one, instead of buying this optimal size, should we buy 1,000 and are we going to make discount savings on the discount? Okay. You said 3%. Let's make an analysis and see. First, what is the savings in the purchase price? Remember, purchase price is 63, which is 7 times the 9, right? Okay, so 3% of the purchase price gives us this. This is what we save. Now let's look at our ordering cost. Okay, savings in ordering cost. So initially, we would have had our the new quantity is what? 1,000. Okay. Otherwise, we will simply have our DO divided by Q. We saw this formula previously. So you calculate this, okay, where there is a discount. What do you get? So typically, you get your 9,000. Okay, you get your 9,000 multiplied by the 5. Okay, which gives us 45 divided by the 1,000, which gives us 45, right? So for the new quantity, you are going to be incurring 45. Whereas in the other quantity, I think it should give us 355. So our 9,000 times 5, okay, divided by 150, giving us 300. 300. You see, so if we are going to be ordering using the economic order quantity, we'll be incurring 300. Okay, we'll be incurring 300. But if we should be ordering using the new quantity of 1,000, we'll be incurring 45. Do we save? Yes, we save. This is lower compared to the higher amount here. So we save 255. We'll add the savings, the discount we are getting, plus the 255. We are talking of ordering cost. We're not talking of holding cost. You know, holding cost will increase no matter what. So we'll look at the holding cost on the other side when we should, instead of holding 150, we hold 1,000. We'll look at what it will also cost. So in terms of ordering, we get a discount. And then in terms of ordering, we save 255. So total savings in terms of ordering is 2145. What about the holding? What about the holding? Instead of holding 150, we want to hold what? 1,000. So find the difference. 1,000 minus 150 times the usual formula. Okay, QH over 2. We get 1,007. So what I'll do now is that I'll compare my 2145 against 1,700. And it tells me that I make an extra savings of 445. Therefore, I'll proceed to order the batches of 1,000 units. It saves me a lot of money. This is what we are talking about. So you should be able to do this cost benefit analysis and to be able to draw valid conclusions. Okay. Again, we have this component of reorder level and lead time. So determine when we should order, we must ascertain the time that will elapse between placing the order and its delivery. And this is what we call the lead time. Now the reorder, at what point should I reorder? So the reorder is normally given by the lead time times either the daily or weekly usage during the lead time. Okay. So assuming we have a usage of 6,000, we are assuming 50 working weeks. We'll have 120 units, right? Easy, just to divide through the 6,000 by the 50. If lead time is 2 weeks per order, then reorder will be what? The lead time, which is 2 times the weekly usage of 120. So lead time will be, okay, will give us 240. Okay, give us 240. All right. So at this point, take an example from the following example. If economic order quantity, let's assume is 600, we will place 10 orders, one every 5 weeks, right? At this point, where we have stock level of 240 from the reorder point, okay, what we are saying is that if the economic order level drops to this level, immediately we should start reordering. Okay, but ideally from the economic order quantity, it means that maximum at the lead time of 5, we should then order to get to our economic order quantity. Once it drops to this very point, then we should trigger a response that we should need to reorder. Okay, and towards to this point and then to that point. So these are the main points that we are talking about. Okay, so the reorder points and fluctuations under conditions of certainty. Okay, so let's simply end it here. In reality, demand and usage are uncertain. A firm should hold safety stocks of raw materials and finished goods to protect itself from running out. Therefore, we should look at safety stocks and reorder points, which is given by this formula. Okay. There are other factors that may influence the choice of order quantity, and we have shortage of future supplies, future price increases, obsolescence, and then taking steps to reduce safety stocks. Okay, so that's it. I'll end here and then we'll proceed. We'll continue with the cash management in the next section. Okay, so that is it for the first portion of our enterprise risk management, specifically under the operational risk management. I'll see you in the next session. Thank you.